Daniel Lacalle, the chief economist at the Treasury's hedge fund, though, he talked about that in his latest op-ed for the Epoch Times. He says China's GDP figures are manipulated by the Chinese regime and don't reflect the reality there.
There are a number of things when we look at the data that simply don't add up. If we look, for example, at the improvement in manufacturing and the improvement in services, most of the big jump comes from rebasing and tweaking with the figures of 2019. So you bring down the number of 2019 and it gives a big jump. It also doesn't coincide such an improvement in the economy as we see in the official figures with the data that we see in inventories, the data that we see in consumption, the data that we see in other metrics that used to correlate very well with GDP. Therefore, there's a number of analysts that are looking at the Chinese economy and that look at it. And obviously, there is a recovery. But in reality, what we would be looking at is more a situation in which the GDP for 2020 will be down 2.5% rather than up as we are seeing, for example, in official figures. So I think that if we look particularly at consumption and at demand, and we look less at the production data, which is obviously dictated by government decisions. So you know that the Chinese GDP is planned basically from government decisions. And therefore, we need to deduct the increase in inventories. We need to pay a lot of attention to what's the real demand driving that growth and the real impact in consumption. If we look at all those things, the Chinese recovery exists, but it's more similar to the ones of other Asian economies.
And we see today, for the first time ever, the Chinese regime have been able to borrow at negative rates. Do all investors and analysts know what you've just told me, or are they in some way deceived by this Chinese figures?
It's very interesting this. The Chinese government has been able to issue negative yielding bonds issued in euros. This is very important because you will hear all the time that the Chinese economy is thriving due to internal demand. But the reality is that debt in China is rising dramatically, in particularly foreign exchange denominated debt, US dollar and euro denominated debt, which exacerbates the shortage of US dollars and shortage of euros that the Chinese economy has. Because yes, it's true that China has strong foreign exchange reserves above $1 trillion, but the level of reserves has been more or less stable for the last year and a half. Yet the reality of the increase in debt in foreign exchange currency is rising much faster. So I think that what investors are looking at is that they believe that the debt is going to be safer because it's denominated in euros or in dollars, and they pay less attention to the overall risk. Today, the IIF showed that the total debt of China is likely to rise to 335% of GDP in 2020. Therefore, I think that investors will pay quite more attention to how the situation of real foreign exchange reserves relative to the debt commitments and debt liabilities that the Chinese economy has in foreign exchange, in order to understand whether we're going to see a massive devaluation of the yuan or a risk of some of these bonds entering into a level of, let's say, increasing spreads in the near future.
330% of GDP. Wow, my mind is blown. Daniel, really appreciate it. Thank you so much.
Thank you so much. Have a good day.